Thanks, Ben. I'm going to talk about tax changes that we already know are due to happen in April, what the Conservatives said in their manifesto they want to do, and then what their wider set of options open to the Chancellor is. The last budget we had, all the way back in 2018, announced a number of tax changes that are due to come in this April, including freezes to income tax threshold, introducing a digital services tax on the tech giants. All those ones announced in the last budget are tax rises. Since the election, the government has officially confirmed 2 tax cuts that were mentioned in the Conservatives' manifesto, a small temporary business rate reduction, but the big one is a £2 billion increase in the national insurance threshold for employees and the self-employed. That's a significant above-inflation increase. It'll take about 500,000 people out of paying national insurance, and those who are still paying it will pay up to £85 a year less. Now, this is about as well targeted as a direct tax cut can be on low earners, but it's important to remember it's still not that well targeted. Only 8% of the gains go to the poorest fifth of working households, only 3% of the gains to the poorest fifth of all households. The other big tax policy in the Conservatives' manifesto was to cancel the latest reduction in corporation tax that is due to happen from 19% to 17%. That reduction is currently in the books, so cancelling it would be a tax increase of about £6 billion. There were a number of other tax policies in the manifesto which were much smaller, so I'm not going to go through them all individually. Broadly speaking, tax rises for foreigners and tax cuts for businesses was the main theme of them. And as well as these individual policies, these specific proposals, they promise reviews of various areas of the tax system, which again, I'm not going to go through individually, but again, don't be surprised to see some action on these. And the first 2 in particular, on business rates and on entrepreneurs' relief, are potentially quite significant. So stepping back from the particular things the Conservatives have talked about, what have they said about their wider hopes and aspirations for the tax system? Well, they've said that they would like to be a tax-cutting government. This is one quote from the manifesto. But as Isabel said, given the current fiscal rules, if they want to increase day-to-day spending, they're more likely to need tax rises. And certainly history suggests that tax rises are the more likely option. This chart shows the tax rise or cut announced in every budget or autumn or spring statement since 1985. And if I bring up when the general elections were, you can see that in almost every case there was a big tax rise in the 12 months following the election. Even if we include 2017, which was an exception to this, the average across all elections since 1992 is £13 billion of tax rises announced in the subsequent 12 months, which might cover the budget in a fortnight, but also, of course, potentially another budget in the autumn. The second thing the Conservative manifesto said about their broader aspirations for the tax system was this sentence, that they want it to boost growth, wages and investment, sounds very nice, and limit arbitrary tax advantages for the wealthiest in society. And that suggests that if they do want to increase taxes, that's where they might look. And there's been lots of speculation in the media in recent weeks as to what that might involve. And so I'm just going to talk briefly through 3 of the most widely discussed options. One that was mentioned in the manifesto is entrepreneurs' relief. The manifesto said they wanted to review and reform it because it's not fully achieving its objectives. Entrepreneurs' relief is a reduced rate of capital gains applied to rises in the value of owner-managed businesses. To give a sense of scale, in 2017-18, it cost the government £2.3 billion. That's about £50,000 each for 40,000 people. But 3/4 of that went to just 5,000 people who were realising gains of more than £1 million each in that year. and they were receiving tax breaks averaging £350,000 each in that year. That may have been what led Boris Johnson to say last month that the Treasury is fulminating against entrepreneurs' relief because some people who are staggeringly rich are making themselves even more staggeringly rich. Veterans of IFS events will know that we're not great fans of entrepreneurs' relief. It's highly distortionary. It's not well targeted at encouraging entrepreneurship. So I would be delighted to see it removed altogether, if possible, alongside other reforms to capital gains tax. The second widely discussed option is restricting tax relief on pension contributions. So at the moment, if I put part of my earnings into a pension, that amount isn't included in my income that year for tax purposes because we're going to tax the money when I take it out of my pension instead. So if you're a basic rate taxpayer, putting an extra £1 into a pension, you're saving 20p of income tax on that. If you're a higher rate taxpayer, you're saving 40p of tax. And so the suggestion is that the government could restrict that so that even higher rate taxpayers only get 20p of relief and they have to pay the extra higher rate tax at the point the money's going into the pension, as well as then paying tax again when they get the pension income out in retirement. So that would be an income tax rise for those higher rate taxpayers who are putting money into a pension. Again, remember that during his leadership bid, the Conservative leadership bid, Boris Johnson was proposing a tax cut for higher rate taxpayers by increasing the higher rate threshold from £50,000 to £80,000. Nevertheless, this is something that the Chancellor could do. It's potentially a big revenue raiser. It would raise about £11 billion a year if everyone carried on putting the same amount into a pension. And we probably wouldn't expect that to happen. We would expect higher rate taxpayers to be putting less into a pension if they were getting less tax relief for that. But if they did that, that would actually bring in more money for the government in the short run, because they wouldn't even be getting basic rate relief on their contributions at that stage. But because there'd be less money going into a pension, it would reduce future revenues because there'd be less pension income to tax when those people came to retire. Previous governments have looked at this and chosen not to do it. What they've tended to do instead is simply reduce the amount you can put tax-free into a pension. Over the last 10 years, those reductions have raised about £8 billion a year by now. And so this is somewhere that the government could look again, but actually we think that there are a number of better places they could look if they wanted to raise revenue from pensions taxation, even from the pensions from taxation of the pensions of the very well-off. Actually restricting tax relief to the basic rate would hit the very best off rather less than others, because the amount that they're allowed to put into a pension each year has already been reduced. The third specific option I'll talk about is the idea of a mansion tax, which could be done as an increase in council tax for properties in the highest bands, or as a separate, presumably national tax. There's a good case for saying that high-value property is under-taxed at the moment. Council tax is a much lower percentage of the value of high-value properties than for low-value properties. And so there is an argument, an equity argument for increasing taxation of high-value properties and, for that matter, reducing tax on low-value properties. If you want to raise tax from the well-off, this is actually quite an efficient way of doing it. It doesn't really reduce work incentives in the way that lots of taxes do. Properties can't move overseas or anything like this, so it's quite an efficient revenue raiser. How much it would bring in would, of course, depend on the tax rate the government set and on how big a property it decided it thought was a mansion. We don't actually know how many properties there are worth more than, say, £1 million or £2 million, because the last time all properties were valued was when council tax was introduced in the early 1990s. When Labour and the Lib Dems proposed a mansion tax on properties worth more than £2 million in the 2015 manifesto, various estate agents came out with estimates that range from about 50 to 150,000 properties, gives some sense of scale. If we want to relate this to council tax, there are currently just under 150,000 properties in the top band in England. And some basic arithmetic just helps to give a flavour of the revenue involved. So if the government wanted to raise £1 billion, a tax on, say, £200,000 properties would have to take an average of £5,000 from each of them. On the other hand, if the government wanted to raise £2 billion from 100,000 properties, we'd be talking about a £20,000 a year tax bill. Clearly, for tax rises of that kind of magnitude, you would need to worry what happened to people who might be living in high-value properties but don't necessarily have a lot of cash to pay the tax. There are options available to mitigate that impact, but it would certainly need thinking about. But if the government did decide to go down that route, I would certainly say it would be much better to fix the many problems with council tax, of which this is only one, rather than layer a second annual tax on property values on top of it. And for those who are really interested, the week after the budget, we'll be launching a report on options for reforming council tax. So looking more widely across the tax system, where else might the Chancellor look for additional revenue? Well, if you look at where the government gets revenue from at the moment, the three big taxes account for almost 2/3 of tax revenue. The Conservative manifesto promised not to increase the rates of those taxes. That doesn't mean that it couldn't get any more revenue in from them. One option will be to reduce the tax thresholds. That will be a big change in direction, given the emphasis that we've put on bringing the personal allowance up to £12,500, the higher rate threshold to £50,000. The national insurance threshold is due to increase in April, and they've said they'd like to increase it further to £12,500 at some point. So that will be a significant change in direction. And the other option would be to broaden the tax base, to bring more things into tax, and that's where things like restricting tax relief on pension contributions could come in. Looking at smaller taxes, well, we already know that corporation tax rate's going to be kept at 19%. The government said it wants a fundamental review of business rates, but the context of that was saying it wanted to cut the burden rather than increasing it. Fuel duties weren't in the Conservatives' manifesto, but during the campaign, Boris Johnson said, "I have absolutely no intention of raising fuel duty." Now, given that fuel duty is assumed to go up in line with RPI inflation each year, if they wanted to freeze it for the course of a parliament, that would actually be a tax cut, a giveaway of £4 billion a year by the end of the parliament, on top of the £6 billion a year that is already being lost from real terms reductions since 2010. Council tax is one possible source of extra revenue. Aside from the mansion tax, councils could be allowed to increase the level that they set council tax rates without having to call a local referendum. But of course, that would bring in revenue for local authorities rather than for central government. Now, local government spending is one of the areas that's been most tightly squeezed, and so it may be a way to allow local authorities to get extra revenue. But if you're looking for central government revenue, we're then looking at this other category. What's in there? The biggest items are alcohol and tobacco duties, but it's actually quite hard to raise very much more revenue from those. If I were really focused on trying to limit arbitrary tax advantages from the wealthiest, capital gains tax and inheritance tax might be where I would look. I've talked about entrepreneurs' relief. There are a number of other reliefs and exemptions in those taxes that you might look at. What the government actually tended to look at over the last few years is to raise more revenue from stamp duties on properties and from insurance premium tax. I very much hope it doesn't look at those again this time. And then there are things like smaller environmental taxes. If you really wanted to annoy the Americans, you could bring in the digital services tax at a higher rate than they've currently got penciled in. So to sum up, there are some changes already due to happen in April. But other than cancelling the corporation tax cut, other things in the Conservative manifesto were pretty small and broadly cancel each other out in revenue terms. In terms of reviews and aspirations, their statements are rather more ambitious, but while they say they want tax cuts, they may need tax rises, particularly if they want to increase day-to-day spending. And history suggests that tax rises are more likely in the year after a general election. Commitments that the Conservatives have made rather reduce their room for manoeuvre on tax rises, and perhaps the most obvious option would be to scale back tax relief, whether that's on pensions taxation, entrepreneurs relief, or elsewhere. But wherever the government goes, it will be nice to see from a government with a big majority at the start of a 5-year parliament a strategic approach, a plan for where it wants the tax system to be going over the next 5 years and beyond, rather than just piecemeal measures to grab revenue where it thinks it can. I'll stop there and hand over to Peter to talk about the really difficult stuff.